Hi guys, this is Mr. Tan, and today we're going to be looking at absorption and marginal costing to try and understand what these are and see how it fits into the profit and loss account. Well, absorption costing is a costing system that is used to value inventory. It not only includes the cost of materials and labor, but also includes the variable and fixed manufacturing overheads. When we look at marginal costing, this is an accounting system in which variable costs are charged to cost units and fixed costs of the period are written off in full against the aggregate contribution. So when we're looking at the different components of absorption costing, these includes direct materials, direct labor, variable manufacturing overheads, fixed manufacturing overheads, and under absorption costing, the costs below are considered period costs and do not go into the cost of the product. So we're talking about the variable selling and administration and the fixed selling and administration. But in variable marginal costing, you have the fixed manufacturing overheads, the variable selling and administration, and the fixed selling and administration goes in to the period costs. So let's look at this diagram in terms of the absorption costing and variable or marginal costing. Here we can see the direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead goes into determining the cost or the average cost of the product. Therefore, you could determine how many units were sold and how much it cost for those products, because we know the unit cost, and then what stock is left, so we can work out the value of the stock that is left. We take the the opening stock plus the closing stock gives you the cost of goods sold. The cost of goods sold minus the sales gives you your gross profit. But we can see the difference here in terms of variable marginal costing, whereby you have the direct materials, direct labor, and variable manufacturing, which goes into the cost of the products, whereas the period sales are the fixed manufacturing, variable sales and administration, and the fixed sales and administration. So if we're looking at an example, and we've got an example whereby a single manufacturer is a seller of a single product in 2016, the company reported direct material costs of $25, direct labor costs of $20, variable manufacturing overhead costs $10, variable selling and administration costs of $5, with fixed manufacturing overheads of $300,000 and the fixed selling and administration $200,000. So we can see here then, to find a unit cost in terms of absorption costing, we've got obviously direct materials, direct labor, and variable manufacturing overhead. So it's $25 plus $20 plus $10 plus the fixed manufacturing overheads of $300,000 divided by the total number of units in the year, which was 60,000 units, gives you an average unit price, product cost under absorption costing of $60 per unit. And once you have the $60 per unit, then you can times it by the 50,000 units sold, which is 3 million, minus the 10,000 left, which is £600,000. And you take the 2 away, you have 2.4 million pounds. So you have your sales minus 2.4 million pounds gives you your gross profit. But we're going to look at these in a little bit more detail. So if we now look and see how those figures and this example fits into the profit and loss account, and we compare it between absorption costing and marginal costing, firstly we can see that there were $100 for each unit sold, and there were 50,000 units sold. Therefore, total sales for both absorption and marginal costing is $5 million. And then we have to work out the average cost of goods per unit. So in absorption costing, we take the direct material cost $25, the direct labor cost $20, and the variable manufacturing overhead cost of $10, which comes to $55 times the amount of units, 60,000 units in terms of the goods, which gives you 3.3 million. Plus, as we've stated before, we have to include the fixed manufacturing overheads of 300,000. So the total cost of the goods is 3.3 million plus 300,000, so that's $3.6 million. And then you divide that by 60,000 units, which gives you $60 per per unit. So if we think about the opening stock, then we times the $60 per unit times 60,000 units, which gives you $3.6 million. And then we know that we've got a closing stock of 10,000 units times the average price, which is $60, gives you $600,000. And then if you take the opening stock from the closing stock, which gives you the cost of goods sold, which is 3 million, and the 3 million which you deduct from the 5 million sales gives you a gross profit of 2 million. But if we compare that to the marginal costing, we can see that in fact the average cost of goods sold is going to be less, because you don't actually have the you don't have the fixed manufacturing overheads of 300,000 in the marginal costing. So what you have is the direct material costs, the direct labor costs, and the variable manufacturing overhead costs of $10. So that's $55 times 60,000 units, which is 3.3 million. And then if you take that divided by the 60,000 units, gives you an average unit price of $55 per unit. $55 times the 10,000 units, which is your closing stock, gives you $550,000. You take that away from your opening stock, gives you $2.75 million. And if you take the cost of goods from the sales, which gives you $2.25 million US. So if we're looking at absorption costing and a marginal costing, we can see now in the gross profit that the gross profit for absorption costing is actually less than the marginal costing, because of the fixed manufacturing overheads which are incorporated in the overall absorption costing of that calculation. But when we come down to the expenses, so FMOH in terms of the 300,000 for the fixed manufacturing overheads, which goes into marginal costing, and likewise the variable sales and administration and the fixed sales and administration. So the only difference in the expenses is going to be the 300,000 for the fixed manufacturing overhead, which now comes into the expenses for the marginal costing. So now when you total up the expenses for both absorption and marginal in the expenses, and you take that away from the gross profit, where you get the net profit, now you can see a net profit of $1,550,000 US for absorption costing, and for marginal costing we can see a net profit of $1,500,000. So here we can see the difference between the two type of accounting systems. Now, when we look at some of the advantages and disadvantages, we can see that there are several advantages, including that it is GAAP compliant, generally accepted accounting principles. But there's a difference between GAAP and IFRS, but I'm not going to get into that now. In addition to that, absorption costing takes into account all the costs of production, such as the fixed costs of operation, the factory rent, cost of utilities in the factory. It also includes the direct costs, such as direct materials or direct labor, and indirect costs, such as the plant manager's salary or property taxes. So in a way it can be useful to determining the selling price of products. But as regards to disadvantages, well, these can include, it includes allocating fixed manufacturing overheads to the product cost. So it's not very useful in terms of decision making when it comes to working out the actual cost of manufacturing a product, because you've got additional costs in there. Absorption costing can skew a company's profit level due to the fact that all the fixed costs are not subtracted from revenue unless the products are actually sold. And if you have a small amount of units being sold within the company, then all the fixed costs are going to be absorbed in terms of absorption costing within the cost of the unit of the product. So it's not really going to reflect the true value, since if the manufactured products are not sold, the income statement would not show the full expenses incurred during that period.